higher life expectancy, inflation, rising medical costs, and an unpensioned society makes retirement planning an essential task for all Indians. Now, a good retirement plan needs to take care of a few necessities. It must offer a regular and continuous stream of income. It should cover large expenses like a medical emergency. And importantly, the money should not run out. So effectively, we can divide the retirement journey into two parts, the accumulation stage and the income generation stage. The accumulation part consists of investing via products like the Employee Provident Fund, PPF, fixed deposits, NPS, mutual funds, LIC policies, etc. And we have a useful video on that effect which helps you figure out the ideal retirement corpus and how one should go about this process. The second part, that is the income generation part, is what we shall focus on in this video as we detail out 10 different sources of income that retirees can utilize towards their post-retirement years. Let's begin. Interest received from fixed deposits is a popular income option among retirees, and one can understand why. A bank fixed deposit is safe, it is easy to start, convenient to operate, offers fixed returns, and has been the practice senior citizens receive an extra interest of 0.25 to 0.5% on their deposited amount. FDs come with flexible interest tenures of 1 month, 3 months, 1 year, etc., which allows retirees to use multiple FDs to balance their requirements. Now, just like bank FDs, there are company or corporate fixed deposits. These are offered by non-banking financial companies like HDFC Limited, Bajaj Finance, LIC Housing, Shriram Transport, etc. In terms of their working, they are a lot similar to bank FDs, but since corporate FDs are unsecured, they do come at a higher risk. And therefore, as a rule, retirees should only invest in AAA rated issues, which symbolizes the highest level of safety given by credit rating agencies like CRISIL, CARE and ICRA. Now, since corporate FDs carry a higher amount of risk, they also offer depositors a higher rate of interest. This table here shows a list of the more popular banks and NBFCs, and one can clearly see the interest rate differential. Of course, things are moving really fast with interest rates, and most of the numbers we'll show in this video are subject to uninformed change. So before taking any decision, please be sure to contact the source directly for more updated information. Also remember, fixed deposits generally don't do any better than the country's inflation rate, which means as a suggestion, retirees should keep the interest money received from FDs to be a small proportion of their income generation pie. The Senior Citizen Savings Scheme is a government-backed retirement benefits program that is specifically designed for retirees. The scheme can be availed from a post office or a bank by anyone above the age of 60 and has a 5-year tenure which can be extended by a further 3 years. Per the scheme conditions, an investment of up to 15 lakh rupees can be made and the interest is payable on a quarterly basis. Now, unlike fixed deposits where a fixed return is offered, the interest rate offered under this scheme is market linked and is 100 basis points or 1% above the 5-year government bond yield. Since this is a very novel and interesting part of the product, let's understand this in greater details. So this graph here is the 5-year government bond yield, and as one might imagine, it goes up and down and generally within the 5 to 8% range. Now, these green boxes represent the previous interest rates offered under the Senior Citizen Savings Scheme, and one can clearly see the 1% markup that the scheme offers over the bond yields, which also means that when bond yields fell dramatically in the year 2020 and the first half of 2021, the scheme's interest rate should, I repeat, should have been slashed down to 6.5%. However, as it would have been a very unpopular move leading to public outcry, the government continued to keep the interest rate at 7.4%, which is where we continue to be as of now. But with the yields inching up again and moving closer to the 6.8% mark, some positive change in the scheme's interest rate is expected when the Finance Ministry reviews it in their next quarterly meeting. So to sum up, your investment in the scheme and the interest payout comes with a sovereign guarantee. The investment is eligible for tax benefits under Section 80C. Interest is paid quarterly. But on the negative side, this interest is taxable. However, that doesn't hide the fact that the SCSS offers one of the highest interest rates amongst debt instruments and is a must-have in any retiree's income generation plan. Yet another product that is specifically designed for senior citizens is the Pradhan Mantri Vaya Vandana Yojna. The PMVVY is a voluntary pension scheme offered by the Life Insurance Corporation of India, which provides a fixed pension for 10 years. Any person above the age of 60 can invest up to 15 lakh rupees in the scheme, which presently promises a return of 7.4%. This percentage might change during the financial year, but once you lock in the contract, your pension shall be calculated at the agreed upon rate for the full term policy of 10 years. Additionally, since this is a government-backed security, it comes with no credit risk. The scheme offers a pension payout in monthly, quarterly, half-yearly and the annual mode. It has a long tenure of 10 years. And of course, the returns are guaranteed, which makes the PMVVY a suitable proposition for retirees and something that all senior citizens should consider. I should also mention here that the PMVVY comes with a deadline, and from what we have read so far, the scheme will cease to take applications after the 31st of March 2023. So you might want to look at this as early as possible, and for more information on the scheme and for the finer details, do visit the LIC India website or call up your nearest LIC agent. The Post Office Monthly Income Scheme is a 5-year maturity scheme that is regulated by the Government of India's Department of Post. The scheme is for senior citizens and risk-averse individuals who prefer not to invest in equities and seek a steady stream of income on a monthly basis. Now, per the current rules, an individual can invest a maximum of 4.5 lakh rupees in the scheme, and the interest is calculated at an yearly rate of 6.6%, which is then paid out every month. The scheme has some additional rules on premature closures, early withdrawals, penalties, etc., details of which can be found on the India Post website. Also note, any investment made in this scheme does not qualify for any tax benefit, and the interest received is fully taxable. So if you put everything together, given the tax inefficiency, the low investment cap of 4.5 lakhs, and a return of 6.6%, which is somewhere around a senior citizen fixed deposit, in our opinion, the Post Office Monthly Income Scheme is an incomplete retirement income solution and should be way below in your pecking order. Real estate is a favorite asset class amongst retirees, and I know of many who have accumulated 2 or more houses in their lifetime. Barring the one that they stay in, the rest of the houses can be and probably does get rented out, on which rental income is received on a monthly basis. In fact, within the real estate domain, while the All India Housing Price Index continues to go through peaks and troughs, one would notice that the rent we pay for our houses, or the rent we make generally, remains the same or goes up in a steady progression. This stability makes rental income an ideal scenario for retirees, and although it comes with some work around maintenance, property tax, bills and brokers, it does offer a neat, almost steady income. This of course brings us to the question, assuming someone has the capital, should he or she buy a property to receive income from it in their post-retirement years? Well, there's no clear answer for this, and a lot more investigation will be required, especially on the rental yields one can expect from that property on an immediate and future basis. You see, rental yields, that is the rent you receive annually divided by the purchase price, are generally low in India. For residential properties, it is in the 2 to 3% range depending on the city that you live in, and for commercial properties, it is a bit higher. But outside of buying property, you can still invest in real estate by exploring alternatives like crowdfunding, managing other people's property, timeshare, and of course investing via a real estate investment trust, on which we have a wonderful know-it-all video on this YouTube channel. A reverse mortgage is a post-retirement financial product that gives senior citizens a regular source of income. The process starts with the senior citizen pledging his or her house with a bank, which then pays a regular amount to this individual over a period of time. As you might have figured, this amount that the bank pays depends on multiple factors such as the age of the individual, the value of the property, the prevailing interest rates, payout tenure, etc. For example, some time back, the Punjab National Bank was paying 435 rupees per month per lakh for a tenure of 10 years. So for a loan or appraised amount of 1 crore rupees, this comes to a monthly payout of 43,500 rupees, which is a pretty decent sum of money. But what makes this monthly payout of 43,000 rupees even sweeter is that the borrower does not even have to pay back this amount. What I mean is, if the borrower outlives the tenure of the loan, which in our case is 10 years, then very simply the bank will stop making any further periodic payments. But this does not mean that the borrower, the senior citizen, has to vacate the property. In fact, the senior citizen can continue to occupy the property until his or her death. Now, when the senior citizen does expire, there are two available options. Option 1 is where the legal heirs can keep the house by repaying that loan of 1 crore with interest. Or option 2 is that the bank can sell the house to recover their dues, and what remains post the sale is paid to the legal heirs. So as a borrower, you get to stay in your house, you get monthly income for a few years, your legal heirs are not likely to be sandbagged by the bank, and if that's not enough, per a recent court ruling, the monthly installments that the bank pays to the borrower are not to be treated as income and are exempted from taxation. Today, reverse mortgages are offered by a few Indian banks and NBFCs like the State Bank of India, Punjab National Bank, LIC Housing, etc., but has seen few takers due to the lack of awareness and the complex process of borrowing. However, and in our opinion, reverse mortgages can be a seriously efficient way for senior citizens to augment their monthly income. An annuity is an insurance contract that's designed to generate a steady retirement income for the annuity buyer. Annuities in India are offered by life insurance companies like LIC, HDFC Life, ICICI Prudential, etc., wherein a policy holder pays a lump sum amount to the insurer against which a regular payout is made to this individual. For example, LIC has this Jeevan Shanti plan, and we particularly looked at a variant called the deferred annuity plan. Now, the way this works is, let's say someone purchases an annuity for 10 lakhs at the age of 53, against which a payout of 1 lakh is made every year after a deferment of 7 years. Which means an amount of 1 lakh is paid from when the annuity buyer is 61 years of age, and per the terms of the contract, he or she continues to receive a lakh of rupees every year until he or she dies. And that's how this simple annuity plan really works. However, there are many variants of the annuity plans, and there are many life insurance companies who offer this, with some giving a higher monthly annuity while some offer a much lower number depending on their internal calculations. So it is definitely in your interest to check with multiple life insurance companies and different annuity providers before coming to a decision. Additionally, if you are an NPS subscriber, then the knowledge of annuities is very important, as the rules require all subscribers to utilize at least 40% of the NPS corpus to buy an annuity. If you want more information on this, then do watch a related video on our channel whose link I have attached in the description below. Many financial planners recommend government securities as an alternative to annuities for the reasons that government issued securities are super secure with no credit risk. These are available for long tenures like even 30 years. These bonds offer semi-annual interest payments. They can be sold in the secondary market. And although there are ups and downs in line with the interest rate, with a little awareness and active investing, one can secure returns in the range of 6 to 8%. Government securities include treasury bills, dated securities, state development loans, etc. And thanks to the launch of the retail direct gilt account, individuals like you and me can now easily trade in these papers. This account was launched just last year by the Reserve Bank of India, and we have a detailed video on the same on this YouTube channel. In our opinion, retirees can consider investing a portion of their corpus in government securities on account of its safety, regular twice-a-year income, and especially if the yields offered are somewhere close to what the senior citizen savings scheme is offering. If that last point is getting satisfied, then we think the government securities option can be a great way to lock in a rate of return in a safe instrument for many years into your retirement. Retirement does not mean that one should stop working. In that context, an excellent strategy to ensure one doesn't run out of money is to work full-time or part-time in your retirement years, which can include remote assignments, taking classes at a nearby college, buying property and turning them for a profit, etc. But while one does this, please do ensure you maintain your books of account properly and record the income generated from work separately for taxation purposes. We've all heard of SIPs or systematic investment plans, which is a technique through which one can buy units in a mutual fund for a predetermined amount and at a predetermined frequency. It's a very popular mode of investing, and the exact opposite of it is the SWP or the systematic withdrawal plan. Simply put, an SWP is a redemption strategy by which investors can withdraw a fixed amount of money at regular intervals from their mutual fund investment corpus. This generates a cash flow for the retiree, and this method offers a lot of flexibility in terms of the amount and the frequency. Additionally, the SWP strategy is long-lasting in the context that investors can continue withdrawing at regular intervals as long as there are balance units in the scheme. This combination of SIPs and SWPs is becoming more likable among investors by the day as mutual funds continue to offer a lot higher returns as compared to other retirement income generating schemes. In fact, do explore ET Money Genius as your retirement corpus accumulation strategy, which comes with a choice of 6 portfolio strategies, tested algorithms that decide on the ideal asset allocation, dynamic rebalancing, better downside protection, and more importantly, Genius offers returns that are higher than its benchmark. So if you haven't yet decided on Genius, then do watch these videos, which are available in English and Hindi, and the link of which is attached in this video's description. A large part of what one derives as income in one's post-retirement years often depends on what is done before retirement. And if you feel you are a bit behind in that area, then do explore employing the one-time services of a financial advisor who can help you with a plan that you can follow then. Now, specific to our post-retirement income, one should look at multiple streams of income rather than relying on just one or two areas. For example, if you were to rely only on rental income or fixed deposits, then a tenant moving out or a sharp turn in the interest rate cycle can truly mess up your calculations. So always have a portfolio-like view of your post-retirement income pie, and if you are in your 40s or 50s, then the right time to build that pie is now. And finally, one important area that every retirement will need to consider is taxation. As you are already aware, different products have their own taxation rules, and a knowledge of the same can visibly improve your post-tax returns. For instance, long-term capital gains on equities are taxed at 10%, and for non-equities, this tax is calculated at 20% but with indexation benefits. Which means if your post-retirement income is likely to fall in the higher brackets of 30%, then using stocks, ETFs and mutual funds may be to your advantage as compared to fixed deposits or annuities, which are taxable as per the investor's tax bracket. So never ignore the tax consequence of one's investments and always plan to get the highest post-tax returns for your capital. And with this, we come to the end of this video. I sincerely hope you learned something new today, and if you know any senior citizens, then do forward this video to them. Thank you for your time. Do like this video, tap on the subscribe button, and I look forward to catching up with you next week. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.